Jonathan, we have to start with this move in oil. At $10 in front of the price of oil. We haven't seen that since the 90s. Just look at USO. That's the ETF, the biggest oil ETF. How much are retail investors getting hurt by this move?
Well, first of all, Sarah, I think there's actually two stories here on oil. The first one is there are some technical things going on with the futures contracts because they're expiring and rolling over tomorrow, which makes this a little bit of an unreasonable read. If you look out further into the June contract or even the contracts that go out a year, they're off, but they're not off nearly as much. My concern, though, is that in general, lower oil, it's not only about the energy sector, which is small, but it's the impact that this is going to have on credit and banks and other sectors that lose money when these energy companies can't pay their loans.
Yeah, I mean, I mentioned retail investor because last week people plowed $1.6 billion into that fund, the USO. So obviously getting hit hard today. Mark, given what Jonathan just said, the ripple effects of this move in oil for the American economy, for the energy sector, for the credit market, are you surprised that the overall market's not down even further on this?
Well, it's encouraging to see the overall market's holding up relatively well with this news. But, you know, it's being hit on multiple fronts. It's the weakness in the economy that has led to this tremendous oversupply of refined product in the United States, and there's no place to store the oil. And I really, what concerns me, I know that you look at it, some of the contracts a little bit further out and they're higher, but I'm not so sure that we're going to see enough improvement that they do not come down as well. And so I'm really concerned that this is going to usher in a much bigger wave of bankruptcies. Ultimately, we're going to have a consolidation in the energy industry. It's going to result in some pretty significant job losses. It's going to hurt Houston. It's going to hurt Texas. There are other things that are going right in Texas, but really some of the higher cost oil producing regions of the United States, they may be in for some harsher adjustments.
What kind of job losses? What kind of income declines? And how widespread do you think it's going to be, Mark?
Well, fortunately, we've already gone through a correction. I mean, we went through a correction in the middle of the decade. And when production rebounded later in the decade, we did it without adding a whole lot of workers. And so I think that in terms of layoffs, when you look at the entire energy complex, because it's not just the folks that are employed in oil and in energy extraction, it's also in construction, it's in manufacturing, the folks who make the equipment. You know, we're probably in Texas looking at job losses, somewhere 100 to 150,000 job losses near term from from cuts in energy. There's a knock-on effects because it's not just that. You also have technology companies that are geared to finding oil and finding the cheapest ways to get it out. And so it's going to reverberate throughout the economy. Texas has a lot of other things that are going right for it. Certainly the tech sector in Austin. Dallas has been getting lots of big corporate headquarters relocations. I think Texas is going to weather this storm, you know, okay. And it's not going to be a replay of the 1980s energy bust or even the 1990s bust, but we're going to have some tougher times in Texas.
Jonathan, I want to talk a bit about the broader market. You know, I'm curious to the extent you're speaking to portfolio managers, people at your firm as well. I don't know if you're having the conversations I have, which are people focused on the economic dislocation, how severe it is, how much more of it is to come, and yet a market that as of this morning, at least before the open, was only down 11% this year. Does that make sense to you? And if so, what explains it?
Well, this is frankly the conversation we're having. If you look at the fact that the unemployment rate probably right now is something close to 17%, if it were to be mark to market given the weekly layoffs that we've had, and the fact that expectations are now for close to a 40% decline in profits in the second quarter, and that number is probably too low. The first quarter is expected to be down 20% in profits, and yet you've only had 3 weeks of the quarter really affected by the shelter-at-home policies. This is going to be, you know, much larger than what we saw in the financial crisis. And you're right. I mean, you're looking at, you know, year-to-date losses 10 to 15% down, and that just doesn't seem to jive. What the real answer here is very simply that the Fed is buying up the market. Now, they may not be buying equities directly, but when they're buying credit, they're effectively doing the same thing. And so you have this disconnect between stock prices and the fundamentals. In the short run, the Fed can clearly play this game as long as they want to. in the longer run, you do have losses here that are going to have to be acknowledged, and the market upside is going to be really limited if the market has been up this high. Just one last point. I mean, we have right now on forward earnings that the market is trading at something like a 21, maybe even higher stock multiple, and that's because the stock prices have held up so well and the earnings are collapsing. Those are on consensus numbers that probably have further to go, and this just means the market is really too expensive given what's going on.